and welcome to the Q3FY23 earnings conference call of Lumax Industries Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantee of future performance of the company, and it may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Deepak Jain, Chairman and Managing Director of Lumax Industries Limited. Thank you, and over to you, sir.
A very good morning to everyone. I hope everyone is in good health. Today, along with me on this call, we have Mr. Anmol Jain, Joint Managing Director. From the finance team, we have Mr. Sanjay Mehta, Mr. Shrutikant Rastogi, and Ankit Chakra. We also have Mr. Naval Khanna and Priyanka Sharma, our Head Corporate Communication, along with SGA Investor Relations Advisors. The results and investor presentations are all uploaded on the stock exchange and the company's website, and I do hope everybody has had an opportunity to go through the same. I'll start by giving some insights on the economy front, followed by the industry and business updates. 2023 continues with volatility, basis on climate changes, geopolitical tension, high inflation, and also high interest rates. The mood in the World Economic Forum was sober. However, India seems to have a silver lining and placed much better than other global economies. India's GDP growth is forecasted to be in the range of 6 to 7% in the coming years, and consistent growth in the economic activity is supported by local consumption and a conducive policy environment, along with a stable political democracy. Over the next decade, India is expected to outperform many fast-growing large economies, and at the same time, the country's OEMs and component manufacturers strive for global dominance. Multiple trends and policies are shaping the future of the auto OEM and the auto component industry. Automotive products will benefit immensely from the supplier's ecosystem in India due to its size, competitive cost structure, and also recent government policy measures. The transition is anticipated to be accelerated by energy and labor cost constraints in the European and US industrial enterprises, and also by the China Plus One strategy on supply chain de-risking. Talking about the Budget 23-24 announcements, the Honorable Finance Minister focused on enhancing consumption by reducing direct income tax, and on the other hand, there was also a 33% enhancement on the capital outlay expenditure, which will directly benefit the overall expansion of the auto industry. Specific interventions like enhanced income tax rebate, budget allocation for car scrappage policy, and import duty exemption for manufacturing lithium batteries are projected to increase demand for entry two-level and fast cars, as well as lowering the price of EV purchasing. As prosperity and consumption increases, India's consumer class is projected to increase from 27 million households in 2014 to 89 million households in 2025, and the auto industry is anticipated to prosper, as well as the expanded consumer class purchases more and better vehicles across all market categories to meet their rising mobility needs. The auto numbers recently published by FADA showed an encouraging trend. The automotive retail sales stand approximately 18.5 lakh, up by 13.5% compared to the same period a year ago. All the categories show a robust growth year on year, with sales of two-wheeler increasing by 10%, three-wheeler by 59%, passenger vehicles by 22%, and commercial vehicles also registered growth of 16%. The sentiments are better than last year, but the rural market is yet to recover due to the rise in cost of ownership. However, with inflation coming down and supply chain stabilizing, we expect the rural markets to bounce back. The company is aligned to execute our order book of 1,000 crore plus in the next 3 years, and we have already commenced the construction of our Pune Chakan plant, for which we expect SOP to be in Q2 of FY 2024. We remain bullish about the domestic Indian industry, particularly in the passenger car segment, which contributes to the majority of the company's revenue. Now, I would like to hand over the call to Mr. Sanjay Mehta for operational and financials.
Good morning, everyone. Share of LED lighting for 9 months FY23 stood at 34% of total sales, and the conventional lighting is 66%. We are optimistic of increasing our share of LED lighting going forward due to increase in demand for premium vehicles and increasing content per vehicle. With respect to segment mix for 9 months, as a percentage of revenue, 66% is from passenger vehicles, 28% from two-wheelers, and 6% from commercial vehicles. With respect to product mix for 9 months, as a percentage of total revenue, 67% of revenue is from front lighting, 24% from rear lighting, and 9% from others. Regarding financial performance in Q3, the revenue from operation grew by 33% on year-on-year basis to rupees 579 crores. For 9 months, revenue stood at rupees 1711 crores as compared to 1202 crores, a growth of 42% on year-on-year basis. Consolidated EBITDA stood at rupees 57 crores as compared to 38 crores, a growth of 52% on year-on-year basis. For 9 months, EBITDA grew by 92% on year-on-year basis and stood at rupees 169 crores. EBITDA margin for Q3 FY23 is at 9.8%, up by 120 bps year-on-year, and for 9 months it stood at 9.9, up by 260 bps year-on-year. PBT before exceptional expenses and share of associate is 29 crores in Q3 versus 17 crores in the corresponding quarter last year, registering a growth of 72%. The profit after tax and share of associates witnessed a solid growth of 115% on year-on-year basis. For Q3 FY23, a growth of 329% for 9 months. And a growth of 329% for 9 months FY23. For Q3 FY23, the PAT stood at rupees 30 crores, and for 9 months it stood at 82 crores. The capex incurred during 9 months is rupees 64 crores. With this, we can open the floor for question and answer.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Ashutosh Tiwari from Equirus Securities. Please go ahead.
Yeah, hi. Congrats on good set of numbers. Firstly, if I look at LED share at around 34% 9 months, it's broadly stable on a YOY basis, despite the fact that probably new model launches, we're seeing higher share of LEDs. And also you also mentioned, I think, a couple of calls back that a new Scorpio, the content is very high, and M&M is one of the drivers of growth in this year. So why is it LED share not increasing despite all these things basically pointing out towards improvement of LED numbers?
So I think you're right. I think if you look at it only from a pass car basis, as well as in terms of two-wheeler, the pass car basically has enhanced. I mean, so it has primarily been in terms of almost, you would say, 66-34. That's what it is. But I think the two-wheeler base, which primarily one of the models that Activa before used to be full LED, that basically is no more on full LED. And that's why you're probably seeing a reduction. But overall, I think we are still bullish, and it remains that the LED will basically grow, hopefully trending up towards 50-50.
But Activa actually, if I remember correctly, it has moved to mix of LED halogen and BS6 only. That happened 2 years back. So that cannot impact the YOY numbers, right?
So it won't impact YOY, but I think the two-wheeler going down, I think that is where basically our base goes down from an LED perspective.
But still, you're confident, like in this 1,000 crore order book that you mentioned, what would be share of LED over there?
So there are two questions. This is Anmol Jain, Joint Managing Director. First, answering to your second question first, the order book of more than 1,000 crores, almost 50% would be LED. So that should significantly change the mix of LED to non-LED in the next 2 to 3 years until when this order book peaks out in the revenue. Number one, coming back on a year-on-year basis, you took only one example of the Mahindra Scorpio. Even though that is a LED technology and yes, the ramp up has happened. More importantly, there are certain other models which have also given a good growth on Maruti platforms as well as within Mahindra. There are other platforms like the Bolero, which are the non-LED ones. So that has kind of neutralized the growth on the LED, and that's why on a year-on-year basis you don't see a significant shift. But we are pretty certain that in the next 2 to 3 years, once this order book comes in, you will start gradually seeing a shift on higher adoption of LEDs.
Okay, sure. And can you provide the numbers, like you mentioned, 9-month capex of around 64 crores. What would be numbers of full year and next year guidance or capex?
So this year, full year, we should be close to around 75 to 80 crores as a full year. And next year, we should be close to around between 225 to 250 crores, out of which the significant part of almost 175 is going towards the capacity expansion in Chakan.
And this 175 crores, can you give how much revenue to us, basically in future, next 2 3 year perspective?
So there are two phases of the new facility. The phase 1, which will be starting from Q2 of FY24, that would give us a peak revenue of roughly around 600 crores in FY25. And the phase 2, which would be FY26 onwards, we are looking at perhaps a peak revenue of around 900 to 1,000 crores out of this facility. But right now, this 175 crores should be able to give us a 600 crore annual revenue as phase 1.
So this is like, part of production from other plants is shift to over there, or this is all new sales you're talking about?
So there is only one model which will be a shift from an existing facility to this facility. However, most of the new order book, and out of this 1,150 crores order book, 90% is new orders, which will be productionized and commissioned in this facility. So for the most part, it will be new revenue for the company.
And this will come in FY25, you said?
Well, the SOP will start in FY24. The peak revenue would be in FY25, FY26. I would say around almost 75% of the order book would get into FY25 and 100% in FY26.
Okay. And this is, like you mentioned, the entire phase 1, phase 2 put together?
The phase 1, I'm right now talking about the order book which is there for phase 1. For phase 2, we are still expecting to close a few more orders in the coming quarters. So that would be over and above the current order book. But it will be commissioned from the same new facility in Chakan in FY26 onwards. As
this 175 crore is there for both the phases or only one phase 1?
I'm sorry?
This 175 crore capex that you mentioned out of total 225 next year, this is only for a phase 1 or both phases put together?
The 175 crores capex is for phase 1, which will give us an incremental revenue of about 600 crores.
That I got.
By 25.
Yeah, that I got.
This 600 crores is a part of the total order book of about 1,150 crores.
Okay, sure. And we have seen improvement in margin and stability over last 2 quarters. This quarter, despite maybe operating deleverage, still we delivered good margins. So how should one look at margins going ahead? Can we go towards that 10.5-11% trajectory going ahead?
We've always maintained that at an EBITDA level, our endeavor is to get into double-digit margins. I think if you look at the quarter 3 for this year, we are pretty much around the similar double-digit level. And I think going forward, we are quite hopeful with the automotive demand in Q4 and even in next year FY24, we should be able to easily deliver upwards of double-digit EBITDA levels.
Sure. And lastly, what is net debt right now?
Net debt. Long-term debt is 66 crore and the working capital is around 304 crores. The debt equity ratio is 0.14 and post that new expansion it will be 0.5 to 0.6.
Okay, got it. Thanks a lot and all the best.
Thank you. A reminder to all the participants, anyone who wishes to ask a question may press star and one now. We have the next question from the line of Nikhil from Simple. Please go ahead.
Hello.
Yes, please go ahead.
Yeah. Thanks for the opportunity and congrats on a good set of numbers. Sir, I have 2-3 questions. One is on the two-wheeler market. Now, if we look at the two-wheeler market construct, most of the industry, the consensus seems to be that the peak of the volumes in industry for two-wheeler seems to be there. So that 21 crore, 2 crore kind of volumes which we had sold in 2018, the industry might not see a peak beyond that. What's your view on that? And secondly, if you look at on the lighting side in the two-wheeler, it's largely a 4-player market between Siam, Lumax, Motherson, Marelli and Unitech. Do you think any more competition would be entering in this market, or would you say that the market will consolidate between these 3-4 players? And in this, how do we look at increasing our market share?
So first and foremost, I think we do remain optimistic on the India market. There is right now commentary, which I agree what you're saying, going on in the industry that we have reached or saturated the peaks, which was 20 million. We don't see that. We feel that this will basically come up, given that if the urban or the rural markets rather start supporting the two-wheeler transition, I think that should come in. Also, of course, there is this whole two-wheeler play of the EV, which by industry forecast itself, they talk about 6 to 7 million going forward. So definitely we remain bullish on the two-wheeler. Right now there is a softening into the market for two-wheelers, but if you see the segmentation has changed. In terms of competition, I would like to just first clarify, it's not Marelli right now, it is actually Varroc. So the 4 players would be Lumax, PM, Varroc, and of course there is Unitech because it's more one customer specific. There is also a little bit of Minda. So there is competition. I don't see any new players emerging out, which will be on the two-wheeler front. There could be certain consolidation, which may happen with the natural course of market turning out.
And if you look at this Unitech, which was the major vendor for Hero and which is under liquidation, so are you seeing any delivery issues for Hero, and are you looking at increasing opportunities to increase our market share in Hero? Which can
well, I think we are stable on the Hero market share, and if you see, whenever basically a supplier is at financial risk, the first thing the OEMs would do is basically de-risk so that they can actually secure their deliveries. And that's probably what Hero is planning to do as well, based on which we have got certain orders. We will be enhancing our wallet share, but our wallet share had already been at quite a high level at Hero, so we remain stable. But of course, there are other players who we have actually penetrated into, like TVS, and that basically enhances our wallet share. HMSI, we remain stable. We do remain stable in Bajaj as a group company. And also, of course, now we probably are looking at another 2 to 3 other players, including certain other EV players.
And just 2 more questions. One is on the 4-wheeler lighting. Now, unlike a 2-wheeler space where there are only 4 or 5 players, in 4-wheeler, we've seen a significant number of players entering in the market, and some of them have scaled up significantly. So, but intuitively, I would have thought that the barriers to entry in a 4-wheeler would have been much more than 2-wheeler. So, why is this a different backdrop? And is it competition has scaled up only on pricing?
No, I think there are 2 points. I think in the four-wheeler, there is a massive tech change. If you see in the four-wheeler, there are all global players. There are hardly very few local players which are there. They are all actually global players with global alliances following their global customers. So I think that's where basically what changes the four-wheeler vis-a-vis two-wheeler dynamics. We really feel that the four-wheeler lighting would continue to technologically evolve more rapidly, more so when basically EVs, the market is also moving towards the higher premiumization of the vehicles. So it's not pricing actually, it is actually going to be more a value addition in technology.
Okay, and last question, sir, on margins. Now, if we compare the global lighting players where the LED penetration is much higher, almost 70-75%, the margins tend to be closer to that, like in the 15 to 20 kind of a band. And even if we look at Motherson Marelli India lighting business, that's also around 17-18. Would you say once we hit a double-digit margin, say 10-11, which we are like sustaining for last 2-3 quarters, is there a more room to increase for us? And or is it like, would you say that probably the global standards won't be the correct benchmark for Indian players to reach?
So first and foremost, I don't think the global standards, what you're talking about, 20% is true for all lighting players except probably one. I mean, say the biggest, largest player would be Koito, then there is Japan, there's a Stanley. They don't basically do these kind of margins. However, I would say that there is a scope for margin improvement from Lumax point of view, and that's what we will basically strive for. I don't really think that about 17 to 20% within the Indian market, which is extremely price sensitive and competitive, that probably would be true for this lighting business.
Okay, and if you allow me one last question. In the last 5-6 years, when the penetration of LED has improved from, say, mid-20s to now at the industry level close to around 35-40, have you seen price erosion happening, or largely the pricing has remained stable?
I think the price has remained stable. Rather, as I said, value addition has basically, or price per vehicle has also gone up significantly. So that is there. Of course, when you look at adoption of LED, I mean, say 3 to 4 years ago when it started adopting, there is the electronic components, which basically LED is focused. That's still a lot import. We do see that once basically the enablers for the PLIs would come in, there would be more electronic component level manufacturing within India, which hopefully should also enhance the localization part.
Okay, but then so that will reduce the RM, the component prices, where so LED prices should move in tandem with the component prices, but not excessive price erosion should happen.
No, absolutely not. You do see that there is a lot of, when you localize any component at a component level, there are also a lot of tangible but also intangible benefits. And that basically gives a lot more competitive advantages to us.
Sure, sir. Thanks for answering all the questions.
Thank you. The next question is from the line of Nidhi Babaria from Envision Capital. Please go ahead.
Congratulations, sir, for good set of numbers. And sir, I just wanted to understand our backward integration, which we did sometime back in Bawal plant. So what was the investment and what is the margin contribution, and how do we see that plant in the coming future contributing to our margin?
So this is Anmol Jain. So the investment we did in the Bawal electronic facility was close to about 100 or 105 crores, and the margin expansion is close to about 120 bits on account of the backward integration.
Okay. And sir, where, like, how does this metrics flow in our P&L? Will we be able to see this margin expansion in our gross margins, or it would come in our EBITDA margin? And how, where does the supply chain fit in our entire manufacturing process?
So clearly, it will come in the gross margin. The material consumption would go down, and of course, there would be certain operating expenses which would have gone up. So it would reflect in the gross margin, and of course, subsequently the EBITDA level as well. But at a PBT, you would not probably see an incremental jump, reasonably because of the depreciation impact.
Okay. And so what kind of returns do we expect from these 105 crore of investments in, let's say, next 1 to 2 years? And this 120 bits margin improvement, from when will it start to reflect in our numbers, or it has already started to come?
So part of it is already started reflecting. I think as we get more and more into localization and more backward integration, we will be expanding the capacities of the electronic manufacturing as well in FY24. So I think clearly there is an upside on the margins. And again, this 100 crores is investment has not given any revenue increase, because the revenue is, as it's backward integration, it only hits the bottom line expansion.
So, sir, why would, I'm just trying to understand why, if the plant has already started to commission, then why only a part of this 120 with margin improvement would have started to come, and why not the entire, from day one, the entire benefit is getting reflected in our P&L? What would be the correct understanding to this thing?
So as I said, the expansion is an ongoing activity. When we talked about 100 crore investment, predominantly we had anticipated 120 bits incremental on the operating margins. I said some of it, or probably most of it, has already been seen in the P&L account. But as we increase the capacities, I'm saying that we should be looking at perhaps upwards of 120 pips advantage as a part of this backward integration. So going forward, when I said that the guidance is to get into the double-digit EBITDA margins and expand them further, part of that expansion of margin strategy would come with a higher backward integration of electronics as well.
Okay. Okay. And sir, there is one line item in our other expense, management support fees, which is roughly 1.3 to 1.5% of the sales. What would be this for, and how do we expect the management support fees to go in near future?
So management support fee we are paying to the collaborator as well as to the Lumax management services, which are extending a lot of services. Like I'm on behalf of Lumax management services taking this call. So all IT related services, legal related services, there are 7 or 8 services which Lumax management services is providing. So these are the combination of both the fees to the collaborator and to the Lumax management services.
Okay. And sir, for this new capex of 175 crores, how much of this is going to be via debt, and how much would be internal accruals?
156 CR is via debt, and the remaining is the internal accrual.
Okay. Okay, sir. Thank you. I'll come back in queue.
Thank you.
Thank you.
The next question is from the line of Komal Ladha from Yellow Jersey Investment Advisors. Please go ahead.
Hello. I just had a few questions. First, have we got any new clients in this quarter, and how much is it from EV and from traditional vehicles?
So we have not got any new client specifically in this quarter. However, we are constantly in conversations with certain clients which are not currently our customers, and we hope to materialize some of it in the subsequent quarters. Your second question on the EV, out of the order book of about 1150 crores, close to 475 crores would be on account of EV, largely driven by four-wheeler and partially driven by two-wheeler electric vehicles.
Okay. And second, could you give a customer-wise revenue mix?
About the 1,000 crore order book, I would not be able to give you a customer-wise breakup. But if you are talking about the customer-wise breakup with respect to the 9 months, Then Maruti, along with Suzuki Motors Gujarat, continues to be the number one customer at about a 32% share, followed with Honda two-wheelers and Mahindra at 13% each, and then followed by Tata Motors and Hero MotoCorp at 9% and 7% respectively. So these are the top 5 customers on a 9-month FY23 basis.
Okay, thank you.
Thank you. The next question is from the line of Abhishek Shah from Wellcore Capital Advisors LLP. Please go ahead.
Hi, sir. Thank you for the opportunity. So just trying to understand, in Maruti, what would be the existing models that we supplied to, say, in this quarter or in the last 9 months?
So on Maruti, we would be on the Swift platform, we would be on the Alto platform, we would be on the WagonR platform, we would be on the XL6 platform. I think the easier would be the platforms which we are not on. I think currently we are not on the Brezza platform or the Baleno platform. These would be the two, and also on the Grand Vitara platform. These are the 3 platforms we are not on, but we are in conversations to hopefully secure orders for their forthcoming new platforms in the coming years.
Got it. And so what about Mahindra and Mahindra and Honda motorcycles?
So I'll take one by one. So Mahindra, we are pretty much there across all platforms, right from the Bolero to the Scorpio and the Thar as well. However, we are not currently on the XUV 700. However, we have already been given a go-ahead for development as a second source, and that's something which is a part of our new order book, will be commissioned in the new facility in Chakan. So we have been nominated as a XUV 700 supplier as a second source already. And your last question was on Honda?
Yeah.
So on Honda cars, we are not really significantly present in any of the platforms on a head or a tail. We do some small lamps on certain platforms, but we are hopeful to secure orders for the forthcoming models.
So Honda motorcycle, sorry, that's about 13% for us, right?
Okay, I was talking about Honda cars. So Honda motorcycle, I think we have pretty much a strong presence across. I'm not too sure, but we are on the Shine, we are on the Activa.
So there is basically the Activa, we are on the Grazia, we basically would also be on your the Shine. We probably are also on the Shine both, and then we is also on the X-Blade and the Scrambler and the Unicorn.
Got it. So lastly, any new models that we've added or been supplying to in say FY24, which are significant or worth noting as such, besides these?
So new model in FY24 for us, I think the major one, as I mentioned, would be the XUV 700. That is a new platform and a new model for us. There are certain others also which are under development, but again, because of non-confidentiality, I would not be able to disclose the model names and the customer to you at present.
Got it. So lastly, just trying to understand the market size of automotive lighting in India for passenger vehicles, two-wheeler and commercial vehicles. Just a ballpark idea.
Well, you can just put it in a way that there are two companies. One is SL, one is Lumax. So both together, which is a Lumax associate company, if you're basically looking at least around about 50% plus. We together are basically doing a revenue of close to around about 3,600 crores. So you can basically just double it, $1 billion.
Got it. And if I would want to know the split, understand the split between the same, passenger vehicles, is it similar to what we have at our company level, or
Well, I mean, so just no. I mean, so if you were to look at it, I mean, so the value add is much more. So I would say the 60-40 would be interesting.
60 would be PV and rest would be two-wheeler.
PV, CV, and basically two-wheelers, three-wheelers.
Got it. All right, sir. That's all from my side. Thank you so much.
Thank you. The next question is from the line of Sunil Kothari from Unique PMS. Please proceed.
Thanks for the opportunity, sir. Really commendable performance, at least compared to many previous years. We are, I think, crossing. I would like to, sir, draw Deepak's attention on page number 36. I mean, slide number 36. I would like to understand from you, sir, is say last 5 years, whether revenue, EBITDA, PAT, everything. I think I'm hopeful that we'll be crossing this peak of last 5 years now onward. We have faced so many tougher challenges and difficult time during last 3, 4, 5 years. We also moved from non-LED to LED during these 5 years. We are also talking about increasing content per vehicle, lighting per vehicles. So how you see what you would like to do over next 3, 5 years? May not be in numbers, but some guidelines, some strategies, some your objective. If you talk from that point of view, will be really helpful.
Sunilji, first and foremost, thank you very much, as always, for your appreciation and also, more importantly, your consistent support. You're right. I think, for us, over the last 4 to 5 years, the industry itself has been actually in decline. But if you see the lighting industry has actually grown. Lumax's today performance, if you see, concurrently we have been betting on technology, we have been betting on LEDs. We have invested actually in the last 2 years largely in these two areas. I think with this we have got a very strong order book. I think a good order book of about almost 1100 plus crores, which we should be able to execute in 3 years. I think key would be for an execution now. And with this execution, if we are able to optimize our cost performance, we should have what we've been always talking about, a stable double-digit EBITDA margin with further expansion scope. So I think that's the first point. Second, I think there has been very strategic customer acquisitions, like for example, we've got TVS, which we do feel that it will become a big player and a consistent big player on the two-wheeler space. We continue to basically, and let me talk about the passenger car because a lot of the revenues from the company is coming in the passenger car business. If you see 90% of the India market is actually controlled by 4 players. We have Maruti Suzuki, we have basically Hyundai, Kia, and I'm clubbing them as one because our associate company, Lumax, caters to both 100%. We have Mahindras and we have Tata. These are the 4 companies which actually control 90% of the passenger car market. I personally don't see a reason where, there will be a large expansion happening in the next 3 to 5 years. I can't say post 5 years. There's obviously a Suzuki-Toyota alliance which is playing in. Our focus as a company is to maybe grow the market share. We have already done that with Mahindra, next is Tata, and retain it with basically Maruti, and of course SL will basically continue to do it with basically Hyundai and Kia. With the two-wheeler, we remain buoyant. There is a softness in the market, but I think there is an opportunity to actually enhance the EV space as well as if EV space continues as bullish as it continues to be, there may be more LED adoption. Clear-cut, there are opportunities in the commercial vehicle space and the farm equipment space, and that I think the company is already aligned in. So I think for more or less, we are pretty busy. We want to basically make good order book and consistent order book with certain key customers and then focus on basically cost optimization.
Mm-hmm. So over the next 3-5 years, one should expect this, some subject to some unavoidable situation, the steady growth and stable and slowly improving margin. That is one should hope for. You as a management also, I think, must be thinking that way.
Well, I think very simply, if I were to just execute the order book what I have in hand, and in 3 years, if it basically puts in 1,100 crores on top of today's, you would say that maybe in 3 years I'm going to grow CAGR of 15%. hopefully the market continues to grow, and I'm saying with this is presumption that the uptick is coming now. Then you probably would have a further enhancement of volume growth. The investments, what we are doing currently, which we're doing in Pune and the other, basically some brownfield expansion, that should help us to support the next 2 to 3 years, basically revenue growth.
Great. Sir, second point is, your all the 4 major customer passenger vehicles, they are also now very eager to produce in India and to export to penetrate international market, and they're already doing at a respectable level. So looking at that opportunity, and second, Stanley, a Japanese player, also very keen to make India as a production hub, production base. So do you see any really big opportunity, not immediately, but over a period from Stanley supports you making as a sourcing base? How you see exports opportunity over maybe in 3-5 years?
See, I think, as I said, the first focus is to cater to the domestic demand. I do believe that the domestic demand will be extremely strong, specifically in the passenger car segment. And for us to basically penetrate and stabilize basically what our customer expectations, that's the first priority. Ongoing dialogue always is there with Stanley, how we can support in their global systems. Currently, Stanley collaborated with India. Next year, we're going to celebrate 40 years of this collaboration. It's primarily to focus on to their customers in India. But I think with more and more Make in India tempo coming in, if you're able to basically give the competitiveness and quality, I do not see any reason why Stanley may not look at India for a particular type of technology to be exported to the world. But as of now, these are just all on discussions, nothing which has materialized.
Right. And sir, my last question is on Lumax. They've done really remarkably well on during 2022, almost 2,000 crore top line. Our sale during 9 months of profit is also very respectable, almost 27 crore. Would you like to comment on the opportunity, possibility, maybe a visible time frame, maybe 2023?
No, I think I can very clearly say that SL rides very strongly on the performance of Hyundai and Kia. You have to please understand that Hyundai, unfortunately, over the last, let's say 5 years, 4 years before, they're kind of saturated at 650 to 700,000. With Kia coming in, they're adventing it, and as you already know, there are market news that Hyundai is looking for maybe new plants in other geographies and expanding its capacities. So I think we are very much committed to be a partner with SL for basically expansion in their Korean, catering to their Korean customers. And I think it's a very, very strategic partnership for us, where they and we each other synergize to focus on SL. Lumax does it for the Korean customers 100%, and Lumax then does it for the other OEMs which is present in India. So we do consider and we do hope that there will be strong performance with Hyundai Kia, overall SL Lumax catering to this for the Indian market.
Right. And sir, this profitability seems to be now stabilizing at SL Lumax also?
Well, as I said, so because your expansion is there is a profitability which basically is having a leverage, and it will basically stabilize with them.
Great, sir. Thanks a lot and wish you good luck. Thank you very much.
Thank you. The next question is from the line of Abhishek from Dolat Capital. Please go ahead.
Thanks for the opportunity, sir. Sir, in 9 months, the revenue growth is around 42%. So how realization growth?
Sorry, your line is not clear. Can you repeat it and just be a little bit more specific?
Hello. Hello, sir.
Yeah, please go ahead.
Sir, in 9 months, revenue growth is 42%. How much volume versus realization growth?
So basically, of the 42%, which is around 488 crores, you could say that 351 crores is volume-based, 137 is value.
And sir, in realization, but how much is because of the product mix and what proportion is for the RM inflation?
So I think there would be probably 100 bits, which basically has impacted in terms of the RM inflation, which we probably are hoping to get with the customers, and we are still in negotiations with them. Balance everything else would be basically on the works.
Okay. And sir, your current capacity utilization has reached to the 85 to 90%. So what is your capex plan for the capacity addition in the coming days, sir?
So already mentioned that this year our capex plan is roughly about 75 to 80 crores for the full year. These are incremental expansions, brownfield, and the major expansion, which is going to be in next financial year, is about 175 crores for the new facility in Chakan.
Okay, sir. And what is your capex plan for FY24? This is 175 crores.
Total would be about between 225 to 250 crores. We are still in the process of making final budgets for the next year.
Okay. And how much incremental revenue will come from this Sanand plant for Maruti Suzuki and MG Motor for this fiscal and for the next fiscal?
So the Sanand plant next year would be probably peaking out to approximately 600 to 700 crores on an annual basis. Some part of the production of the Sanand plant would be also shifted to the Chakan plant. And as I mentioned earlier, the 175 crore capex on the Chakan new facility will give us a peak revenue of roughly about 550 to 600 crores as on FY25.
Okay. And my last question is related with the forex loss or gain. So in last 9 months, how much is the forex gain or losses because of the fluctuation in the currency?
4 crore foreign exchange loss we have incurred up to 9 months.
How much, sir?
4 crore.
Okay, sir. Thanks, sir. That's all from my side.
Thank you. The next question is from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Congratulations, sir, on good set of number, and thank you for the opportunity. To just understand, sir, if I'm not wrong, your quarter 4 is the best quarter among all the quarters, right? And so just to understand, I did get about the expansion plan, etc. Just to understand how, so would it be right to say that we'll be ending somewhere, close to 2,300, 2,400 crores revenue for this year, and say a roughly 15% growth for next 2 years, considering your capex?
Yeah, that would be fair to estimate.
Okay. And since the phase 1 of the capex and with the order book in visibility of the order book, so and with 50% LED and non-conventional, so what would be the change in EBITDA mix, just to get an idea what would be the type of improvement we might see in the EBITDA mix?
So again, it's very difficult because EBITDA would be an outcome of multiple factors. Product mix clearly being one, technological shifts, but obviously in order to, the process technologies are very different, so there may be certain incremental costs as well. But I think I've always maintained a guidance that our endeavor is to close towards the teen EBITDA, which is, let's say, 13% or upwards. I think first step, this year we should be definitely looking at a double-digit EBITDA. And post that, probably be trying to achieve somewhere around 12% in the next 12 to 24 months. That would be our guidance from an EBITDA expansion.
Okay, I get it. Just one last question. So just to understand it, so if say I'm going ahead and producing LED as compared to the conventional, what would be the spread between that? I mean, LED would obviously be both more EBITDA, better EBITDAs compared to conventional. So what would be that spread between that EBITDA for the LED to conventional made?
So it's not necessarily true. In general, yes, you're right. EBITDA, or because the contribution per vehicle of a LED lamp is much more than that of a conventional lamp, the fixed costs do get proportionately distributed, and the EBITDA margins are fairly better on an LED. Generally, it's true, but not always. So I would probably not be able to give you an exact incremental expansion vis-a-vis a conventional to a LED on a lamp per se, but I think overall, we are very confident that because 50% of the order book is LED, we should be able to easily expand our margins in the forthcoming years.
Okay, so means you have in your mind of reaching the 13% EBITDA, 12 or 13% because you see that the LED is going to 50% of your business, right? More or less, the idea is that, right?
That's correct.
Thank you, sir. And all the best.
Thank you.
Thank you. Before we take the next question, a reminder to all the participants, anyone who wishes to ask a question may press star and 1 now. The next question is from the line of Ashutosh Tiwari from Equirus Securities. Please go ahead.
So you mentioned that you will be second source in Q3FY23. What would be our share in that?
Well, right now I would say that it would start at about a 50-50, and maybe once we are in production, it could also get ramped up to perhaps a 60-40 or a 70-30, depending on where the total volume of XUV700 go. But clearly, as a second source, we would be getting into a 50% wallet share.
And this will start from second of next year, 24?
This would start from somewhere in quarter 2 of FY24, quarter 3 of FY24, depending on the exact product development timelines and approvals. But yes, definitely in Q2, Q3, FY24.
And is it like several part of this LN50 order book that we have today?
Yes, it is a part of the 1150 crore order book that we have today.
So is it like a large part, a significant part of that order book?
It's not a very significant large part of that order book, but I mean, it is definitely, I think, close to maybe about 15% of the order book or so. So it's not, it's significant from one point, but it's not as significant, it's not a half of the order book or something.
Okay. And you mentioned 475 crore order book is for electric vehicles out of the 1150 crores. So, and these are existing models or the new model launches from Tata and Mahindra, or it is only Mahindra?
No, these are new launches, and these are not necessarily Tata or Mahindra. These are also other OEMs which have announced their EV plans, both in the four-wheeler and two-wheeler. And so we have secured orders of four-wheelers for the most part out of this 475 crores.
Okay. And this 600 crore revenue from phase 1, partly to the XUV700. So is it out of the 600 crore? Is a meaningful sales shifting from Sanand to this plant?
Can you repeat that, please?
So you mentioned 600 crore revenue from the phase 1 of this Sanand, Chakan plant, and you also mentioned there's some part of production from Sanand shift to Chakan. So is it like a large chunk shifting from Sanand to Chakan, or is it a small business only out of the 600 crores?
It's close to about 100 crores, which would be a shifting business. So for the most part, it would be still new business, which would be coming in. And this is largely on Mahindra, as I said, the XUV700, as well as certain platforms of Tata Motors.
Okay, got it. Okay. That's all from my side. Thank you.
Thank you. There is a follow-up question from the line of Abhishek Shah from Valcor Capital Advisors LLP. Please go ahead.
Sorry, sir, I just missed which models in Tata do we supply? Tata Motors? Hello?
Yeah, could you repeat that question?
In Tata Motors, sir, which are the models that we supply to?
We are having Nexon and Punch platforms for the phase 1 in Chakan.
Okay, all right. Thank you.
Thank you. There is a follow-up question from the line of Nidhi Babaria from Envision Capital. Please go ahead.
Thank you, sir, for taking my question again. Sir, I just wanted to ask you the Bawal backward integration, in which quarter did we started the facility, and how much investment do we plan to do in the same facility in coming years?
I think the Bawal facility was started in Q4 for FY22. And going forward, you said how much expansion? I mean, I don't see a significant one. It will be part and parcel of the 60 odd crores capex apart from the new facility which is planned for next year.
50 odd crores.
No, I said total capex next year, ma'am. As I said, it will be about 225 to 250 crores, out of which 175 crores is the new Chakan facility. The remaining, which is around 50 to 70 crores, out of that, some part of it, I don't know the exact number, but not a significant one, would be towards the electronic bowel facility.
Okay. Okay, and sir,
Yeah, it would not be 50 crores. I just wanted to correct you there.
Okay. So, sir, I also wanted to ask, our gross book has increased significantly over past couple of years, but our top line growth hasn't been the same. So what could be the reason for that, and how do we expect our margins to move in coming years?
So you're absolutely right. So there are two predominant reasons for that. Number one, the investment on the electronics facility. Number two, there was also a shift for a very high volume model of Maruti Suzuki from their Manesar facility to their Gujarat facility. And since lamps being very fragile, we have to produce them next door to our customers. So there was a partial duplication of capacities to service our customer, which did not really give us an incremental revenue, but the gross block did go up. So these are the predominant reasons why you're not seeing a revenue jump in the last 3 years. However, we, as I mentioned, have a very strong order book, and we do not anticipate a very hefty investment after this Chakan facility to fulfill that 1,000 crores, 1,200 crores order book. So going forward, you will see a shift in our asset turnover ratio as well. In terms of margins, I've already mentioned the guidance for the next 12 to 24 months would be to stabilize the double digits and try to attain 12 to 13% EBITDA margins.
And this double-digit margin would come via operating leverage, or are we also planning some more backward integration apart from the current electronic component which we have already done?
It would be a mix of both, but for the most part, it would be operational efficiencies and obviously fixed cost rationalization on the incremental revenue.
Okay. And sir, the royalty fees and management fees and everything, how much are we planning to, how much is it going to sustain in the near future? And is there any plans of renegotiating on our royalty plans?
No, we as I said, we are having a 40-year relationship with Stan Electric. We basically will continue to pay this kind of royalty to Stanley for their support for the global technology.
Okay. And sir, the 1150 crore of order book, from where is this expected to come on our production line?
I told you 1150 is going to be executed in the next 3 years.
Will it start from Q4, like Q1 FY24 or Q2 FY24?
So FY24 would be roughly 25% of this order book. It would get to 75% in FY25 and then 100% in FY26.
Okay. Okay, sir. Thank you.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Deepak Jain, Chairman and Managing Director, for closing comments. Over to you, sir.
Thank you, everyone, for joining on the call. I would also like to say that we do remain very confident on the growing prospects of India and the automotive sector. I hope that we have been able to respond to your queries adequately, and for any further information, I request you to get in touch with SGA. Thank you very much and stay safe.
Thank you, sir. On behalf of Lumax Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.